Hi, this is Professor Arujo with a overview of Module 4. If you get to the module to-do list, you'll notice that Module 4 is actually on two chapters, Chapters 5 and Chapter 6. There are quite a number of steps to complete. But again, one chapter at a time and one objective at a time has always been the motto here. So chapter 5 and 6 are done together because they really revolve around inventory. Chapter 5 introduces you to merchandising operations, which is the same basically as retail. And as you know, a retail store, the whole purpose of retail is to sell their inventory. But before they can sell their inventory, they need to buy it first, put it in the store, and then the customers come and buy it from them. So I don't know why they call it retail. I think they should call it resale. Okay, enough jokes today. So basically, Objective 1 introduces you to how inventory plays a role in the merchandising area and merchandising businesses. And because merchandisers revolve around and selling their inventory, their income statement's going to look a little bit different. You're going to be introduced to two new items on their income statement. One is called the cost of goods sold. The second is called gross profit. And so those types of things you'll be introduced to in Objective 1. Learning Objective 2 and Learning Objective 3 are based on the exact same invoice. Again, this is based on business-to-business transactions. One business might have inventory, maybe they've created it because they're a manufacturer, and they sell it to another business. So business-to-business transactions are very, very common. And so Learning Objective 2 and Learning Objective 3 in this chapter focus on that business-to-business transaction. Same transaction, but Objective 2 looks at it from the buyer's perspective. Objective 3 looks at it from the seller's perspective. And so you're going to look at the exact same transaction from two different perspectives. Learning Objective 4 introduces you to the differences between something called a single-step income statement and a multi-step income statement, which is a wonderful thing in my view. So do pay attention to all of that. Those are important. Learning Objective 5 introduces you to some financial analysis and calculations on how we actually do some understanding and analysis of something called a gross profit margin and a net profit margin. And that is how Chapter 5 wraps up. Okay. Chapter 6, and of course, there's a review. Chapter 6 picks up where Chapter 5 left off. Learning Objective 1, all the information here you should have already understood from Chapter 5, so it shouldn't be more than a quick review for you. But the most important part of Chapter 6 is the second objective. This looks at how businesses cost out their inventory. Now remember, businesses are buying inventory all year long. So because they have to sell it and they have to assign a cost to what they sold, it's called the cost of goods sold, they have to have a method to assign costs. And so Objective 2 in Chapter 6 looks at the common methods that are used. The ones that are focused on in this class are the methods called FIFO, LIFO, and average cost. There is a fourth method that you do not have to know. It's called specific identification, but you don't have to know it in this particular course. But FIFO, LIFO, and average cost will take up much of your time in this chapter. Learning Objective 3 talks a little bit about the value of inventory, because inventory is an asset. Assets cannot be overvalued. And so there's a method called the lower of cost or market method that's used to make sure our value of inventory is correct. And then there's some more financial ratios in this. So one of them is the inventory turnover ratio, which is how many times per year a store is selling out their inventory. And obviously the higher amount of times is a plus depending on the store. Walmart would have a very high inventory turnover because they tend to have lower prices, so the inventory moves quickly. But there's other retailers that have much higher price goods. They'll have a lower inventory turnover ratio. The number of times per year, basically, they sell out the store. Once we know the inventory turnover ratio, we can put that number below 365 days to calculate the number of days we keep inventory in stock before it's sold. And that's the days in inventory method. There's a chapter 6 review quiz. And then after that, exam number 4 is on both chapters 5 and 6, everything you've learned in these 2 chapters together. Please note the due date. You do have several days to get this one done, but it moves quickly. There's a lot of stuff here. So please make sure you have all of that done.